Breaking this morning, the US dollar is under intense pressure. As we come on the air in January 2026, global investors are on edge, questioning the future of the world's most powerful currency. We're diving straight into this developing story to explain what is happening and why. And the story really has to start with this number, over $36 trillion. That's the U.S. national debt right now. It is an unprecedented figure, and it's casting a very long shadow over the entire global financial system.
So, this raises the critical question that everyone is asking this morning. Is this staggering mountain of debt finally starting to crack the foundation of the dollar? All the signs we're seeing are pointing in a very clear and very concerning direction.
To put it simply, the dollar is being squeezed from all sides. It's caught between major economic forces, both here at home and from around the world. Let's break down what that squeeze looks like.
And we can see the direct evidence right here in the numbers. The US dollar index, that's what measures the dollar against other major currencies like the euro and the yen, has just hit a multi-year low. Now, this isn't some minor dip. It's a significant trend, and it tells us that global investors are getting nervous. They're actively rethinking how safe the dollar really is. So the big question is, why now? What is causing this dramatic shift? Well, our analysis shows there are 4 key drivers pushing the dollar down. We're going to investigate each one by one. And first up is the Federal Reserve. The actions, or really the expected actions, of the U.S. Central Bank have an absolutely massive impact on the dollar's value. Okay, so here's how this works. Think of high interest rates like a powerful magnet for global money. They offer a great return, so capital flows in. But right now, the markets are betting that the Fed is about to cut interest rates to try and boost the economy. The moment that happens, that magnet gets weaker, the return for holding dollars drops, and big money investors immediately start looking for better deals elsewhere.
The second driver brings us right back to that $36 trillion number we started with. For years, this was seen as a problem for the future. Well, the future is now. The sheer scale of this debt is hitting the markets in real time.
And this quote really gets to the heart of the investor mindset. See, it's not just the total debt, it's the trajectory. The U.S. keeps spending way more than it brings in year after year. That's a massive fiscal deficit. And so, the people who lend the U.S. money are starting to ask a really tough question. Can this go on forever? Even a little bit of doubt there is enough to weaken the currency.
Now let's look at our third driver, because this isn't just about the numbers on a spreadsheet. It's also about confidence. And right now, that confidence is being seriously shaken by policy uncertainty coming out of Washington. Global markets need one thing above all else: predictability. But they're not getting it. Instead, they're seeing 2 big sources of instability. First, the constant use of trade tariffs is messing up global supply chains. And second, any hint of political pressure on the Federal Reserve sets off alarm bells. Investors have to trust that the central bank is independent. When that trust wavers, holding dollar assets suddenly feels a whole lot riskier.
And that brings us to our fourth driver, which is really the logical result of the first 3. With lower returns, debt concerns, and all this unpredictability, big money is on the move. We are witnessing what you could call a great global reallocation of capital. This chart shows you exactly what's happening. For decades, the default move was to park money in U.S. assets. But look now, investors are diversifying. They're actively moving money into Europe and into high-growth emerging markets where they see better opportunities. They're not totally pulling out of the U.S., but they are spreading their risk. And the very act of selling dollars to buy something else, well, that's what pushes the dollar's value down. So we've talked about these huge global forces, but the question is, why does any of this matter to you? Let's connect these headlines directly to what's in your wallet.
A weaker dollar isn't some abstract concept. It has real-world consequences. First, anything you buy that's made overseas, your phone, your coffee, your car, it's all going to get more expensive. Second, if you're planning a trip abroad, your money just won't go as far. And third, on a bigger scale, the value of your savings, your retirement accounts, all of it has less purchasing power on the world stage. Here's a really simple way to think about it. Just 2 years ago, back in 2024, $100 might have gotten you a very nice dinner for 2 in Paris. Today, that same $100 bill, well, it might just barely cover the main course for 1 person. That's a direct hit to your personal buying power. So when you put it all together, the debt, the policy changes, the global shift in capital, it paints a picture of a very uncertain future. This raises the serious question: what happens next for the dollar? So what does this all mean? Look, the era of the dollar probably isn't over,
but its role could be changing in a fundamental way. We might be witnessing a historic shift away from singular, unchallenged dominance to just being one of several prominent currencies in the world.
And that leaves us with this final, powerful question. For most of our lives, the entire global financial system has been anchored by the US dollar. What does a world that isn't dominated by a single currency actually look like? That is the new reality we may all be heading into.